Thank you for choosing this session about pre-issuance. It's going to be very interesting, and I have an esteemed panel with me who will be introducing themselves shortly. But just to set the scene, I think, a little bit in terms of what is pre-issuance and what are we going to be talking about. Pre-issuance is the focused on all the kind of credits and projects that are going to be coming to the market in the future. I mean, we've heard from Alistair this morning. There is loads and loads of investment going into projects. We've also heard about there's going to be a big supply crunch and there's lots of demand. We all know that credits are an inevitable part of the net zero transition for pretty much every organization. So there's a race to sort of invest and get ahead of the kind of supply crunch and the quality crunch, and pre-issuance is one of the ways in which people are doing so. So I'll just introduce myself shortly and then move over to the panel. So for those of you who don't know me, I'm Jess. I lead the sort of ratings and assessments at Silvera. Been with Silvera sort of since the beginning, and my role has been to oversee the design and the delivery of all of the assessments that we provide, such as the ratings and more recently the expansion to pre-issuance as well. And with me I have Anna from Respira, Chris from Standard Chartered, and Thomas, a very own Silveran as well. And I'll just hand over to them to sort of introduce themselves in order and what their role is with pre-issuance.
Thank you. I'm Anna, as Jess said, from Respira. We are an impact-driven carbon finance solutions business. We started the business back in 2019, and I think we have been in pre-issuance from day one. The way that we wanted to support the development of the voluntary carbon markets was by entering into long-term offtake agreements with developers of primarily nature-based projects. And we did that by essentially giving them a guaranteed price for future issuances of carbon credits so that they had that price certainty as a bankable security effectively.
My name is Chris Leeds. I'm the head of carbon markets development at Standard Chartered. Standard Chartered, you may or may not know, is a global bank located in London, but with much of its offices, and our footprint is mainly in Southeast Asia, Middle East and Africa. And so what we see as our raison d'etre, our purpose, if you like, is to really help investors in the developed world, the global north, if you like, help them to invest and to support businesses in our footprint in the global south. Actually, when it comes to climate finance, that really does ring very true with what with us as a business. When you think about where most companies and people are going to be affected by climate change, they're in the developing world, in the emerging markets, and where's the capital? It sits in the developed world. It sits in the global north. So that's what we're trying to do. I also sit on the Integrity Council for the Voluntary Carbon Market. I'm one of the board members. And we've been working on our core carbon principles to really create a high integrity, high quality market to really bolster that quality and that integrity that you see that we need in the market. Working through the assessment of the standards and the various methodologies, making good progress. I think we made some quite tough calls recently. And there will be more to come, but we are looking to try and develop the market of the future. So one that is fit for the next 10 to 30 years, and that will help us to get to net zero by 2050, or as quickly as possible. So that's what we do. And as a bank, obviously, we look to lend, we look to use our balance sheet and to support the development of projects, and very much we're trying to do that in the carbon markets. And then we can also use our balance sheet to help with trading and developing the risk management products that we need to see to support growth of the market. And we can talk about that a little bit more throughout the panel.
Good afternoon, everyone. So I'm Thomas Eyre, Vice President of Pre-issuance Solutions at Silvera. So I essentially designed the infrastructure to help our clients deploy capital in early stage projects. And I have a background in finance. I spent 10 years in private equity. Prior to that, I was also part of the team that built Uber in its early days in the UK and Ireland. and I then founded a climate tech startup called Phoenix Carbon, providing standardized data for carbon finance.
Great, thank you. Thank you, everyone. Very exciting to have lots of different perspectives and sort of types of involvement in the pre-issuance space. But I think before we even get into that, perhaps setting a little bit more context about why there has been this race to sort of significant investment in projects coming to the market. And Anna, I'll start with you. What would you say are the main drivers for this sort of increased large volumes of investment? We've seen quotes of sort of $7 to $8 billion a year going into these projects coming onto market. So what's driving it?
I think the cycle has changed a bit when voluntary carbon markets 2.0 really sort of started in 2019, 2020. There wasn't a lot of competition for supply. This is when we entered into the market, and the way that we first started was, as I said, through using an offtake model, which was essentially a delivery versus payment model. We then sort of started to see a lot more interest coming into the market, and you had larger groups who were coming in and starting to make direct investments into project developers. And then you had, corporates who were also looking to position themselves into this sector. And in fact, I remember, 2 years ago having these discussions when the London Stock Exchange had just launched its VCM funds platform. And I remember them saying, well, we want to set up a platform where corporates can basically secure their supply directly through a fund-listed exchange vehicle. I remember saying to them and having this discussion exactly, I said, that's great, but if a lot of the projects that we're supporting are in the global south and we want to have, a lot more sort of kind of revenue sharing and benefits sharing, our role is actually to maximize the price for the project developer. Whereas if a corporate is coming in directly and securing, offset supply through, through prepayments or through investing in the project developer directly, their motivation is price minimization, right? They want to hedge their cost and their exposure. So there's a bit of a tension between those two different motivations. I think now where we are in the market, it's a lot more challenging to raise that capital to invest in project developers. And there is this tension between, where you do still have institutional capital that's coming in. But again, as I say, they're wanting to invest in the project developer directly. But then they say, however, we will only invest into the project developer if you've got an off-taker in place. And yet when you're trying to raise that capital to essentially act as the off-taker, they sort of say, oh, no, we want to be earlier in the value chain. So we are in quite an interesting position at the moment. And most of the demand that's coming through is coming through, these buyers clubs that we have been probably hearing about all this time, like Symbiosis and Frontier, et cetera.
Yeah, and I think that kind of speaks to this sort of chicken and egg challenge that we were calling it when I think we were talking about this panel just beforehand. So Chris, I'd be interested to hear your perspective as well.
Yeah, so I think, obviously Anna's covered a few of those points, but in the VCM 1.0, if you like, and again, I don't want to use those terms too much, but when VCM first started going and projects were getting developed, many of the projects were being financed out of equity, basically companies and project developers coming in and being able to finance that out of their own pocket. And this is because the actual capital costs were relatively low. They could afford to do that, and also they didn't really want to be selling carbon credits, fixing into long-term offtakes at potentially quite low levels. So why not take merchant risk? They sit there and say, well, we'll sell those credits as and when we need to, and we'll basically get our return back in the merchant market, if you like. And also, corporates would tend to probably come once a year. They would come sporadically. They're not buying every day, and there's not a market. It wasn't a market like that. Now, I think what's happening is that as the capital costs are increasing, as the size of these projects are increasing, and particularly when you're looking at some of these industrial projects, but even with the nature-based projects, you are looking at larger, more expensive capital. You need to put a lot more financing in. There's a lot more risk. And so you need that risk transfer. And this is what the financial system is all about. It's about risk transfer. And so now what's happening is that, as Anna says, if you want to raise capital, you need to be able to demonstrate that you can actually pay it back, right? That you can generate a return. You need to be able to show that up front, even whether it's equity capital, so your cost of equity and what that's going to actually generate in a return, or indeed debt capital. And obviously, as a bank, that's what we're more interested in. But if you're looking for debt, the first thing that my credit officer is going to ask is not how much we're going to make; it's how do we get our money back. And so you're going to have to be able to show that up front. And an offtake can essentially can guarantee that. So if you say, well, I've got an offtake at $20 a ton for 1 million tons a year for the next 5 years, that's $100 million of revenue that you can generate that can be used to make a return or to obviously repay debt. And so that's what we're starting to see, that kind of development of, quite frankly, pretty standard practice. This is what happens in most markets. Certainly most commodity markets, but even in property markets and things like that. There's always we need to see sight of the cash flows to be able to actually justify extending that credit. And the cost of credit, the cost of capital is the name of the game. People want to be able to reduce those costs. The higher the risk, the higher the costs. The lower the risk, the lower the costs. And so by putting in offtakes, you are de-risking and therefore able to reduce some of those costs. So I think, we're seeing that develop. And then what we've seen to a certain extent is companies coming in and saying, well, I'll do the offtake. The actual buyers are doing the offtake or potentially other intermediaries, and they're providing the capital as well. They're doing prepays. They're putting the money up front. But again, that's not efficient. That is not how financial markets work. Banks have got obviously cheaper access to capital, so we want to find out other ways of, again, de-risking even further so that banks will come in and they're prepared to lend against those projects. So you may have a creditworthy offtake or a creditworthy buyer, but if your project is the technology is high risk, or the country that you're in is high risk, or you yourself as a project developer are high risk because you don't have a deep enough balance sheet, then those are the other things that we need to look at as a financial institution. And we're starting to see other techniques coming in, including insurance, to help de-risk again the market and to be able to help it scale. But it's all about scaling. It's all about getting more and more money in so that we can actually provide the finance that we need to see these projects and see decarbonisation take place.
I think that was a superb overview, and Tom, I'd like to hear sort of from you when you were founding Fenix, which was focused on sort of enabling carbon finance through data standardizations. What were some of the challenges that you were hearing about, and sort of who you were talking to?
I think in terms of the challenges that we've heard from many clients is that clearly there's this shift operating to the word, the pre-issuance market, and people are embracing it because they want to secure access to, the high-quality projects, the best projects. They want to, control the quality of those projects because when they invest early on in those projects, they get the opportunity to monitor the implementation of those projects throughout the life of the project. But admittedly, most companies, again, getting into that, do it for the first time. So they're wondering about a lot of things. So they're wondering, where can I find the projects to invest in? Those early stage projects, where can I find them? Do I need to engage with project developers one by one? I need tools to be able to see all those projects in one place. I cannot be going through every single registry and talking to every single broker. And once they've got their hands on a long list of early stage projects they could invest in, they need some tools to conduct due diligence and to understand, are there any red flags? Is it safe to invest? Am I not going to lose my money? Am I actually going to get my credits? And once they've invested in the project, it's not the end. The deal is done, but there's still a lot to be done. They usually, invest for several years, sometimes decades. So they don't want to, invest a few millions and then, wait and hope for the best. They want to monitor their projects. They want to make sure that those credits are going to be issued eventually, and when they do, they're going to be high quality. So they need tools for all of that. And currently there's bits and pieces everywhere in the market, but it's lacking this one place where you can find everything. So that's something that we've seen at Phoenix Carbon, and also something that we're seeing at Silvera. So at Silvera, we started with ratings, and as Al explained, we're now building this end-to-end platform, which is this one place where people can find all the information that they need. And so you saw it with our, we're offering this catalog where our users can find a list of 20,000 projects and get access to some filters and some screening tools to identify the most attractive ones that they want to focus on. Once they've got to a short list of a few projects that they want to invest in, they can use our detailed assessment to due diligence the project. And once they've invested into those projects, they can use our ongoing assurance product to monitor those projects. So ongoing assurance is essentially Silvera's project monitoring tool to help our clients reduce uncertainty on the execution of the project, manage relationship with project developers, and overall maximize the quality of the credits that are going to be issued in the end.
So I think a kind of theme that's emerged quite naturally almost across what all three of you have said is we started off talking about the complexities of setting up the right financing structures, but then also tensions that perhaps come with integrity or the need to monitor for it or be equipped with the data to ensure the projects coming to market are high integrity. And Anna, you mentioned about that tension of price minimization versus value maximization. So I'm kind of curious to dig into that a little bit more, that particular challenge of integrity, but getting your money's worth, depending on which party you might be in that agreement. So just want to understand a little bit more about how you deal with that challenge at Respira or any other challenges you see that arise from these natural tensions.
I don't want to... I don't know about the rest of you. Am I allowed to say something just a bit? We've all done so many panels, haven't we? And
say whatever
go for it. There's no, we're all amongst friends, Anna. So just say what you like.
Aren't you all a bit fed up of hearing the word integrity? I hope that we've all got integrity, and obviously we all want to act with integrity, but it's so kind of morally loaded, right? And the reason why I just thought of it, was to your question about price maximization versus cost minimization. I mean, if you're looking at it from a project developer point of view, obviously you want to have price maximization for your credits. And a bit of the tension that comes in is that when you are short of capital and you're therefore going for prepayments, not even off-takes, you're essentially locking in a price. So. And you don't know, and as you're saying, for 10, 15 years, you have absolutely no idea what the price is going to do during that period of time. And where you want to be with your, with your sort of stakeholders is that 10, 15 years down the road, you still got happy stakeholders and happy partnerships. And this was a challenge for us when we set up Respira and our offtake model, because again, take yourselves back to 2019, where we had no futures curves, we had no forward pricing curves. The VCM was still sort of kind of in the doldrums, and Red Plus projects were high quality. Red Plus projects were probably trading at, I don't know, $2-3, and the only buyers for those credits who'd locked in long-term offtake agreements were the oil and gas companies. So we thought, okay, how can we set up a pricing structure that's going to be win-win and fair, given that no liquidity, no price transparency? So the way that we approached this was to essentially say to these project developers, look, okay, we'll commit to buy from you. We'll give you a fair floor price, which is already at above cost of production, and we'll fix that floor price so you have your downside guaranteed. But what we will do, so that you can also participate in the development of carbon markets, is we will then rebate back to you anywhere between 25 to 50% of the gross margin that we make on those credits when we eventually sell them. So in that way, those project developers can also get to participate in the price appreciation and the development of the markets, which is why, when I was having those conversations with the London Stock Exchange, I say, our motivation is price maximization, not just for us, because, at the end of the day, we're also a profit-making entity, but also for the developers. Whereas when you're selling directly to, a corporate through a prepayment, the other motivation, of course, is for them to, or even us or all of us, to sort of kind of want to hedge your price risk and your exposure to that price risk and to that supply risk. So that's where there is a bit of a tension. And as I say, this is, I think that's why I wanted to sort of take it away from the word integrity, because, this isn't really necessarily sort of integrity related, it's just economics.
Yeah, and I'd totally back that up. It's basically, and what you're doing is good business, because at the end of the day, if you're certainly as a developer where you're going in, you're trying to create trust, you're trying to create some sort of relationship with the people that you're doing business with. If you're seen as somebody who's always going in and lowballing and essentially not supporting them, well, they're not going to work with you. And so, and also, if you've bought credits at a very low level and then the actual market price ends up being much higher, you've created a risk for yourself, because you created a risk of default, because the project developer might turn around and say, do you know what? I'm not going to sell to you. I'm going to go and find somebody else to sell it to. So that happens again in all these markets. This is not just common to carbon markets. But what we are lacking is the actual market, as Anna has alluded to. The fact that there isn't a forward curve, that there aren't price indices, that there aren't the risk management tools that you can use, so you can say to your counterparty, your supplier, your partner, well, you tell you what, well, we'll pay you this fixed price, we'll pay you a floor price, but we'll then share the difference based on an index that will be settled at sometime in the future. So if the price ends up going to $100, $200, whatever, well, we're going to take 50. We'll take half of that and share that. And that's just a sensible way of managing the risk. It's not a case of being nice to people necessarily, although of course we should certainly be nice, and that's part of the integrity piece. But it's about good business, and I think what we want to see is the market develop. It's why secondary markets are so important. It's why standardization is important. It's why trust in the market is so important, because then you can create the risk management tools. You can create the indices that can, again, manage that transfer of risk. And that's what it's all about. It's a risk transfer, and that is where we will get a market that's high integrity.
I think that's very interesting what we just heard, and I'd echo that in a slightly different way. I think what we see is that this market has been a bit unstructured for a while, and what we see, we start seeing the emergence of a structure with different people playing distinct roles in this market and finding ways to work together. Now, of course, there's been tensions because people need to start working together, understand what works, what doesn't work, to come to sort of like repeatable transaction structures that actually work. I think what I hear from what you both said is actually the need of alignment of interest between the different parties, between project developers, between off-takers, between financial investors. And so how do we create these repeatable transaction structures that create the alignment of interest so that everybody wants to achieve the same thing, which is sequester carbon from the atmosphere to preserve our planet. So we see like a number of ways of working together. We've mentioned the offtake agreements, whereby like corporates partner with, or funds partner with an early stage project to commit to buying their credits and give them upfront funding for that. We also see like, the three-way SPV model whereby, project developer partners with an off-taker to provide the visibility on the cash flows and the buyer committing to buy volumes at a pre-agreed price. And this visibility that it provides on cash flow enables to bring financial investors that bring in the capital, so that the corporate off-taker doesn't necessarily need to pay the capital upfront. And so we see like a number of transaction structures that are emerging, works for everyone, and are being repeated. And this is what this market needs essentially to scale.
And I think it's maybe worth, we've highlighted, I think, a lot of the challenges, a lot of the emerging solutions, and I think before we shift over to what I'm sure will be plenty of questions, I think I wanted to just end on a note almost of advice. Based on what sort of has been emerging so far, what would you say either as an investor or a potential off-taker in the pre-issuance space in order to understand what's the best financing structure for them, perhaps the right project types, how to manage quality or delivery risk or whatever it might be? What data should they be sort of equipping themselves with before making that decision on how to engage with these projects or these other parties in the pre-issuance space? And sort of love to hear a perspective from each of you. So Anna, as my first victim, as always.
I thought I asked you not to ask me questions first today. I think it really depends on the type of project that you're looking to invest in. There's a big difference between, maybe sort of looking to invest in an engineered removals project, where I would say, with a lot of these opportunities, it's more about, I think, actually investing in the equity of the developer there, because being an off-taker in an engineered removals project is quite difficult, because the pricing of those credits right now are, I don't know, $600, $1,000, and I know that there have been important signals that have been sent, but to enter into prepayments to long-term off-take agreements at that price level is quite risky, particularly when I think the expectation is that as the technology becomes more scalable, that price is going to come down. I think it goes to, somebody was asking a contango question earlier. So that's one type of consideration. And then if you're looking at nature-based removals or reductions of forest conservation, where there's a significant community involvement in those projects, the consideration is very, very different, right? Because there you really have to, it isn't just about the carbon baseline, which I know has been subject of a lot of debate and a lot of improvements, rightly, but the whole community rights, biodiversity rights, FPIC, the whole sort of environmental and governance aspects of it is a completely different level of due diligence that you have to do on those types of projects. So I think it really depends on what you're looking at.
So, I think it also depends who you are. So if you're a sophisticated buyer, a Microsoft, a Volkswagen, or even some of the oil companies, you've got large teams, huge amount of resource to be able to go out and both invest and purchase carbon credits. Then you're in a much better, stronger position. You know where to find the information. It's a different ball game. What we want to see, though, is we want to see ordinary corporates coming into the market and being comfortable and confident to be able to go and to participate. We want everybody to start taking responsibility for their emissions and to invest into carbon projects. They need to reduce their own emissions and they need to invest. But to do that, we need to create simplicity. We need to be able to make it as easy as possible for companies to come into the market. Right now, it's no surprise that there's a dearth of buying. It's because it's much easier to do nothing than it is to do something, and we want companies to do something. So I think we as an industry have to help them and provide the information. And I do think that's the sort of thing that the rating agencies can do, to be able to explain terms like FPIC, to be able to explain the difference between an engineered removal and a nature-based reduction project. So, that I think is what the industry needs to do, is to help people as much as possible. We certainly need to change the narrative to make it absolutely unacceptable to do nothing, but we also need to help companies to be able to do something.
I think it's like my advice for people investing in early stage projects on what, like the question is about what data should they ask for, agree to access. I think I would advise mostly to agree on sharing data simply. It's like often people invest in a project without thinking that they're actually committing to a 10-year relationship and thinking how are we going to manage this 10-year relationship. So at the moment of the investment, this is when there is a need to have a conversation about what is the data that you're going to provide me at which cadence to give me comfort that things are going according to plan. And so it's important to have this conversation, and exactly as Anna said, the list of data point is probably going to vary depending on the project type.
Well, I think that's a superb spectrum of all of the different things to be considering when moving into the pre-issuance space. It's about getting educated on the project types, the kind of risks that may arise, which will be dependent on the project type itself, knowing what data to be looking for from an implementation perspective, but then also keeping simplicity at the heart of what we're doing, because we need people to not be scared by this market, but able to engage with it through these sort of financial structures. Thank you very much to the whole panel here. Please join me in a round of applause for them.